I was going through supply chain reports yesterday afternoon, cross-referencing mine production data with export figures, doing that thing where you're trying to reconcile numbers that should match but don't. And I kept hitting the same wall. Mexico. The math wasn't adding up. Mexico is one of the world's largest silver producers. They mine over 170 million ounces a year. That's roughly 20% of global mine supply. And yet, the amount of refined silver actually leaving Mexico and showing up in North American mints, European refiners, and Asian markets has been dropping. Not a little, a lot. And when I started digging into why, I realized we have a problem that almost nobody is talking about. And it frustrated me because this is the kind of structural issue that doesn't make headlines until it's already choking supply chains. So here it is. Saturday, February 21st, 2026, Chicago time. Comment what day and date you're watching from, because this story is unfolding in real time, and I want to know where you are when this information reaches you. And real quick, if you value breakdowns that connect supply chain mechanics to market reality, do me a favor, subscribe and comment FinTalk OG so I know you're here for the deep work. Now here's the story most people are missing. Mexico has been steadily implementing policies over the last 2 years that make it harder, slower, and in some cases nearly impossible to export raw and refined silver. This isn't a sudden ban. It's a creeping nationalization through regulation, taxation, and bureaucratic friction. And the stated reason is resource sovereignty. Mexico's government has made it clear they believe Mexican resources should benefit Mexico first. That means prioritizing domestic refining, domestic value-added production, and domestic consumption before allowing exports. On the surface, that sounds reasonable. But in practice, it's creating a bottleneck that's rippling through the entire North American silver supply chain. And if you're buying silver coins, if you're a dealer, if you're a manufacturer that uses silver, or if you're just trying to understand why premiums keep climbing, this is the story you need to understand. So I'm going to break down 3 things. First, what Mexico is actually doing, the specific policies and mechanisms that are restricting silver exports, and why this is different from a mine shutdown or a labor strike. Second, how this is affecting North American supply chains, from Canadian and U.S. mints to industrial users to the premiums you're paying at the dealer. And third, what this means for the silver market in 2026 and beyond, and what you should actually do if you're holding, buying, or using silver. This is going to be detailed. This is going to be technical. But if you care about where your silver comes from and why it's getting harder to source, you need to hear this. Now, before we get into the mechanics, let me give you the big picture. Mexico is the world's #1 silver-producing country. Depending on the year and the data source, Mexico produces between 170 and 190 million ounces of silver annually. That's about 20 to 23% of total global mine production. To put that in perspective, Peru, the #2 producer, does around 110 to 120 million ounces. China is around the same. Then you have a big drop-off to countries like Australia, Chile, Poland, and Russia that each produce 30 to 50 million ounces. So Mexico is the anchor. And the majority of that Mexican silver has historically flowed north to the United States, to Canada, to be refined, minted into coins and bars, and distributed. The U.S. Mint, the Royal Canadian Mint, private mints like Sunshine, APMEX's refining partners, all of them have relied heavily on Mexican silver. And that flow is being squeezed. Here's what Mexico is doing. It's a multi-layered strategy that doesn't fit neatly into a single headline. Layer 1, Export licensing requirements. As of late 2024 and into 2025, the Mexican government began requiring export permits for unrefined and semi-refined silver products. That means if a mining company in Mexico wants to ship silver concentrate or door bars to a refiner in the U.S. or elsewhere, they need a permit. And those permits are not automatic. They require documentation, environmental compliance proof, tax certifications, and most importantly, they're subject to discretionary approval by government agencies. The approval process has been getting slower. Requests that used to take days or weeks are now taking months in some cases. And some permits are being denied outright with vague justifications around domestic supply needs. Layer 2. Taxation and royalty increases. Mexico has been steadily raising mining taxes and royalties. Recent changes have included higher extraction taxes, environmental fees, and a controversial royalty on gross revenue rather than net profit. That last one is key. If you tax net profit, miners can offset costs and reduce their tax burden. If you tax gross revenue, you're taxing the top line regardless of whether the mine is profitable. For low-margin operations, that's brutal, and it creates an incentive for miners to either scale back production, focus on higher-grade deposits, or if possible, process and sell domestically where they can recapture some value instead of just exporting raw material at a loss. Layer 3. Domestic refining mandates. The Mexican government has been pushing for more silver to be refined domestically rather than exported as raw material. The logic is straightforward. If you export raw silver, you're exporting jobs and value-added activity. If you refine it domestically, you keep those jobs, you build industrial capacity, and you can potentially export higher-value refined products. To incentivize this, the government has been offering tax breaks to domestic refiners and making it harder for miners to export unrefined material. The problem is, Mexico doesn't have enough refining capacity to handle all the silver being mined. Building refineries takes years and hundreds of millions of dollars in capital investment. So in the meantime, you have a supply bottleneck. Silver is being mined, but not leaving the country fast enough because the refining capacity isn't there. Layer 4. Resource nationalism and political rhetoric. This is the softer, but equally important piece. Mexico's current administration has been vocal about resource sovereignty and reducing dependence on foreign markets. They've explicitly said that natural resources like lithium, rare earths, oil, and yes, silver are strategic national assets. That rhetoric creates uncertainty. Even if the formal policies aren't a full export ban, the political climate makes foreign buyers and miners nervous. If you're a U.S. or Canadian company sourcing silver from Mexico, you don't know if next year there's going to be a new rule that cuts off your supply entirely. That uncertainty leads to defensive behavior. Companies start looking for alternative sources, even if they're more expensive, just to reduce concentration risk. Now let's talk about the numbers and why this matters so much. If Mexico produces 170 million ounces a year, and roughly 60 to 70% of that has historically been exported to North America for refining and minting, that's around 100 to 120 million ounces flowing north annually. The U.S. Mint alone strikes tens of millions of Silver Eagles every year. The Royal Canadian Mint produces millions of maple leafs. Private mints produce tens of millions more rounds and bars. All of that requires feedstock. Refined silver that meets the purity specs for minting. If the flow of Mexican silver slows by even 20 or 30%, that's 20 to 30 million ounces that aren't showing up. And there's no easy substitute. You can't just flip a switch and source that volume from Peru or Australia overnight. Those supply chains are already committed to other buyers. Refiners in Europe and Asia have their own customers. And spot market purchases are expensive and volatile. Here's what's actually happening on the ground. And I'm basing this on industry reports, dealer feedback, and conversations with people in the supply chain. 1. Lead times for silver products are stretching. Dealers are reporting that orders placed with mints are taking longer to fulfill. What used to be a 4 to 6 week delivery window is now 8 to 12 weeks in some cases. Why? Because the mints are waiting on feedstock. They're having to source silver from multiple suppliers instead of relying on the steady flow from Mexico. And cobbling together supply from different sources takes time. 2. Premiums on North American coins are staying elevated. As of mid-February 2026, premiums on silver eagles are running anywhere from $10 to $18 over spot, depending on the dealer and the volume. Canadian maples are in the $8 to $15 range. Generic rounds are $6 to $10 over spot. Those premiums have been sticky. They came down a bit after the January silver crash when spot dropped from 110 to the 70s, but they didn't collapse the way they would in a normal market. Why? Because physical supply is still tight. The crash was in paper silver, futures, ETFs. Physical silver didn't suddenly flood the market. People who own physical held on, and mints are still struggling to source feedstock. 3. Some dealers are limiting purchases. There are reports of larger dealers putting caps on Silver Eagle orders or making certain products available only to existing customers. That's a tell. When dealers start rationing supply, it means their pipeline is uncertain. They don't want to take orders they can't fill. And they don't want to burn through inventory only to find out they can't restock at a reasonable cost. 4. Industrial users are feeling the pinch. Silver isn't just for coins and bars. It goes into electronics, solar panels, medical devices, switches, contacts, you name it. Industrial buyers typically source refined silver through long-term contracts with refiners or through spot market purchases. If Mexican supply is constrained and refiners are prioritizing their existing customers, new buyers or buyers trying to expand volume are getting squeezed. That shows up as longer lead times, higher prices, and in some cases, manufacturers having to slow production or substitute materials. So let's connect this to the bigger picture. Why does the Mexico problem matter so much for North America specifically? Because geography and infrastructure. Mexico is right next door. Shipping silver from Mexico to the U.S. or Canada is cheap and fast compared to shipping from Peru, Australia, or China. The infrastructure is already in place: roads, rail, border crossings, refining relationships, all of it. If that flow gets disrupted, you can't just reroute through another country without friction. Shipping from Peru to the U.S. means longer transit times, higher costs, and different refining relationships. And Peru has its own issues: political instability, mine strikes, environmental protests, permitting delays. Same with Chile, same with Bolivia. Latin America as a whole is a tough place to operate in mining right now. Mexico was supposed to be the stable, high-volume supplier, and now it's not. This is also hitting at a time when silver demand is rising. Industrial demand is strong. Solar panel installations are growing. Data centers are expanding. EVs are scaling. And investment demand, even after the January crash, is still elevated compared to historical norms. So you have demand going up and supply from the largest single source getting squeezed. That's a recipe for persistent tightness. Now let's talk about why Mexico is doing this. Because it's not arbitrary. There's a logic to it, even if the execution is messy. Reason 1, economic nationalism. Mexico's government wants to capture more value from natural resources. They look at silver and see billions of dollars worth of metal being mined, exported, and then sold back to Mexico as finished products at a markup. They think, Why not keep the refining, the minting, the value added activity in Mexico? Why not create domestic jobs and industrial capacity? That's a politically popular position. It resonates with voters who feel like foreign companies have exploited Mexican resources for decades. Reason 2. Fiscal pressure. Mexico's government is dealing with fiscal deficits, debt, and pressure to fund social programs. Mining taxes are an easy revenue source. Miners are profitable, they're extracting valuable resources, and raising taxes on them is less politically risky than raising taxes on consumers or small businesses. So the government is squeezing miners because they can. Reason 3. Environmental and social concerns. Mining in Mexico has a complicated history. There have been environmental disasters, community conflicts, and accusations of corruption. The government is trying to show it's taking environmental protection and community rights seriously. That means more regulation, more oversight, and more bureaucratic process, and that slows everything down, including exports. Reason 4. Strategic leverage. This is the quiet part. By controlling silver exports, Mexico has leverage over the U.S. and Canada. If North American mints and manufacturers are dependent on Mexican silver, that's a bargaining chip. It can be used in trade negotiations, in disputes over immigration policy, in energy or water issues. Resource nationalism isn't just about economics, it's about geopolitics. Now here's the uncomfortable question. Is this going to get better or worse? My read is it gets worse before it gets better. Here's why. The political incentives in Mexico are all pointing toward more control, not less. The current administration has a mandate for economic nationalism. There's no domestic political constituency pushing for easier exports and lower taxes on foreign miners. The opposition isn't offering a radically different vision. So barring a major political shift, the trend is toward more restrictions, more bureaucracy, more domestic refining mandates. And even if domestic refining capacity does get built out over the next few years, that new capacity is going to serve Mexican demand first. The government isn't building refineries to export more silver. They're building them to keep silver in Mexico. On the other side, North American buyers are slowly waking up to the risk. The U.S. and Canadian governments are starting to talk about critical minerals and supply chain security. There have been funding programs for domestic refining. There are tax incentives for reshoring. But talk and action are different things. Building a refinery in the U.S. or Canada that can process tens of millions of ounces of silver per year is a multi-hundred-million-dollar project. It takes years to permit, years to build, and you need steady feedstock. If all the ore is in Mexico and Mexico won't let it leave, what are you going to refine? You'd have to source from other countries, which brings us back to the same problem. Limited alternatives. So what actually happens in the next 12 to 24 months? My base case is this. Mexican silver exports continue to decline or stay flat. North American mints continue to struggle with feedstock. Premiums on physical silver products stay elevated, probably in the $8 to $20 range depending on the product. Some smaller mints or dealers go out of business because they can't source inventory. Industrial users lock in long-term contracts at higher prices or start substituting other materials where possible. And the U.S. and Canadian governments announce plans to build domestic refining capacity, but those plants don't come online until 2028 or 2029 at the earliest. In the meantime, we live in a higher friction, higher cost, tighter supply environment. The bull case, the scenario where this resolves favorably, would require one of the following. 1. Mexico reverses course. Unlikely. 2. A massive new silver discovery somewhere outside Mexico that can fill the gap. Possible, but takes years to develop. 3. Recycling ramps up significantly. Plausible, but slow. Recycled silver comes from scrap electronics, old jewelry, industrial waste. When silver prices are high, recycling becomes more economic. But you need infrastructure to collect, sort, and process scrap. That doesn't happen overnight. Or 4. Demand destruction. If silver prices rise high enough, industrial users find substitutes. Solar panels use less silver per panel or switch to copper in some applications. Electronics makers redesign components. That's possible, but also slow. Technology doesn't pivot on a dime. The bear case, the scenario where this gets worse, would involve one of these. 1. Other Latin American countries follow Mexico's lead. If Peru, Chile, or Bolivia implement similar export restrictions or raise taxes aggressively, the entire Latin American silver supply, which is nearly half of global production, gets locked up. That would be catastrophic for Western supply chains. 2. Mexico goes further and implements an outright export ban on raw silver, forcing 100% domestic refining. That would cut off North American mints entirely until alternative supply can be secured. 3. Political instability or mine strikes in Mexico shut down production. If mines stop producing, there's no silver to export or refine domestically. That's a lose-lose. Or 4. A trade war escalates. If the U.S. imposes tariffs or restrictions on Mexican goods, Mexico retaliates by cutting off silver exports. Unlikely, but not impossible. So what should you actually do with this information? Let's get practical. If you're holding physical silver, this is bullish for your position over the medium term. Tighter supply, elevated premiums, and structural bottlenecks mean the physical metal you own is becoming relatively more scarce. Don't panic sell because spot price is volatile. Physical is physical. The premium you paid is starting to look like insurance against exactly this kind of supply chain disruption. If you're buying physical silver, here's my advice. 1. Expect to pay premiums and stop waiting for them to collapse. The days of $3 overspot silver eagles are probably over for the foreseeable future. If you can find product at $10 to $15 over spot, that's the new normal. Accept it and move on. 2. Diversify your product types. Don't only buy government coins. Consider bars, rounds, and junk silver. Bars tend to have lower premiums. Junk silver, old U.S. coins, are already in circulation, so they're not dependent on new minting. 3. Buy from dealers with diversified supply chains. Ask your dealer where their silver is coming from. If they say Mexico only, that's a red flag. If they say they source from multiple mints and refiners across different countries, that's better. 4. Consider buying in bulk when you can. Dealers often offer better premiums on larger orders because it's more efficient for them. If you're serious about accumulating, buying a tube or a small monster box is more cost-effective than buying 1 ounce at a time. If you're a dealer or a mint, you already know you have a problem. The solution is painful, but necessary. Diversify your feedstock sources. Yes, it's more expensive to source from Europe or Asia. Yes, the logistics are harder. But relying on a single country, especially one that's actively restricting exports, is existential risk. Pay the higher price, build the new relationships, and pass the cost on to customers. They'll pay because they don't have a choice. Also, consider investing in or partnering with domestic refining capacity. If you're a large enough mint, it might make sense to own or co-own a refinery so you control your own supply chain. If you're an industrial user, this is a wake-up call. If your company uses silver and you're not locked into multi-year supply contracts, do it now. Talk to your procurement team this week. Lock in supply even if it means paying higher prices or committing to volume. Because if you wait and there's a supply shock, you might not be able to get silver at any price. Also, explore substitution and design changes. If you can use less silver per unit or switch to an alternative material in non-critical applications, start testing that now. It takes months or years to redesign products and get them through certification. Don't wait until you're in crisis mode. If you're an investor in mining stocks, the Mexico problem is a double-edged sword. On one hand, constrained supply should support higher silver prices, which is good for miners everywhere. On the other hand, Mexican miners are getting squeezed by taxes and regulations, which hurts profitability. And if you own a Mexican silver miner, you have to price in political risk. The government could raise taxes again. They could nationalize operations. They could make it even harder to export. That's a real risk. So if you're investing in miners, bias toward companies in more stable jurisdictions. Canada, Australia, the U.S. Even Peru, despite its issues, is probably more predictable than Mexico right now. Now let's talk about the second-order effects. What does the Mexico problem mean for the broader silver market? First, it adds another layer of bullishness to the physical silver story. We already have China controlling 60% of global refining. Now we have Mexico, the largest producer, restricting exports. That's two major choke points in the supply chain getting tighter at the same time. If you're a long-term silver bull, this is confirmation of your thesis. The paper market can stay irrational and volatile. But the physical market is tightening, and eventually those two markets have to reconcile. Second, it increases the probability of a two-tier market, a world where paper silver trades at one price and physical silver trades at a significant premium over that price. We're already seeing that. Spot is in the high 70s to low 80s. Physical products are trading at $85 to $100 when you add the premium. If supply gets tighter, that gap could widen to $20, $30, even $40. At some point, that becomes unsustainable. Either spot price rises to meet physical, or physical premiums have to compress because buyers walk away. My bet is spot eventually rises because the physical tightness is real. Third, it changes the risk-reward for new silver mines. If you're a mining company looking to develop a new silver project, you're now looking at a world where Mexico is getting harder to operate in and China controls refining. That makes projects in other jurisdictions more attractive: Nevada, Alaska, Canada, Australia, even parts of Europe. We might see more capital flow to non-Mexican, non-Chinese silver projects. That's good for long-term supply diversification, but it takes 5 to 10 years for a new mine to go from discovery to production. So it doesn't help the supply crunch in 2026 or 2027. Fourth, it puts pressure on governments to act. The U.S. government has been slow to take critical minerals seriously. But if American mints can't get silver, if solar panel manufacturers can't get silver, if defense contractors can't get silver for electronics, that's a national security issue. We might see government funding for domestic refining, strategic stockpiling, or even trade pressure on Mexico to ease restrictions, but government moves slow. Don't expect a solution this year. Let me also address the question I know people are asking. Could Mexico pull a full nationalization? Could they just seize the mines and cut off all exports? It's possible, but unlikely. Full nationalization is a huge step. It scares off foreign investment in all sectors, not just mining. It invites sanctions and trade retaliation. And it doesn't actually solve Mexico's problems. If they nationalize the mines, they still need to operate them efficiently, refine the silver, and sell it. State-owned mining companies have a terrible track record globally. They're usually corrupt, inefficient, and unprofitable.